I'm going to start the recording here, and I'll turn this over to our guest speaker, Keri Jacobs.
Hi, good afternoon, everyone. Keri Jacobs here, December 20th, CALT webinar, Understanding Ag Cooperatives, Equity and Patronage. First of all, thanks to Christy for helping manage this, or for doing all the hard work on this, and CALT for having me over here. As Christy said, this is the first webinar we're doing on cooperatives, and with any luck, there'll be some more to follow this. I'm here today to talk about cooperative equity and patronage. And there's probably some information in these slides that, there we go, that might be too basic for some of you, and other stuff that you want to know more about. So I tried to find a middle of the road, and if you have questions, I'll certainly try to answer those. As Christy said, I'm not a tax professional, so I'm an economist, and I'll do my best. I've learned a little bit, picked up a little bit working with auditors and others. Real quick about my position, I just finished teaching a class at Iowa State University on cooperatives. It's a 300 level economics class there, and I do director training and other training with cooperatives. Today we're going to hit on just some terminology, basics of cooperative equity. I'm going to talk about some of the tools that managers and boards and their auditors use in managing equity, cooperative equity. In particular, we'll hit on qualified and non-qualified allocation, some of the redemption strategies that you might, if you're a producer member, you might hear your cooperative board talking about, or if you're a tax professional, you might get questions about. And then, of course, we'll also hit on DPAD, that domestic production activities deduction. I'll share with you what I know, and more importantly, what I think some of the impacts are, or things to look out for, impacts of DPAD. And in particular, I'm interested in helping understand what some of the member producer impacts are here as well. How do I, now you can, okay, there we go. So just some really quick, some terminology. I'm going to introduce terminology in terms of whether it's profitability or how profits are used or tax implications. But I just want to be really clear up front of what we're talking about when we talk about co-op equity and how it gets there, and also how it's distributed. It obviously, as you all know, equity comes from the ability to generate profits. And at the co-ops, they have two different streams of profits, and one is local savings. These are profits or savings, they use those terms interchangeably, that are generated at the co-op level. And importantly, some of these profits are from member business and some are from non-member business. And when I mean member of an agricultural cooperative, I'm talking about someone who has paid for a membership at the co-op, and they have to have production at risk. This is different from a straight patron. These are members. Some of their business, some of co-op's business is for members, some is non-members, and that's an important distinction when we get into allocations. They also have then, in addition to their local savings, what they're able to produce based on their local operations, whether they be a single location or 75 location cooperative, they have this additional income from regional cooperatives or joint ventures, but I'm going to talk about this income that they get from regional cooperatives, and those would be their cooperative partners like CoBank, Land O'Lakes, CHS, AGP. These are cooperatives of cooperatives. So we'll talk about that too, because those are important in the distinction. This is an example of an operating statement or an income statement for a cooperative, and really one of the big differences you're going to see if you're used to looking at income statements is the difference between, in that bottom line, that local savings or loss, and then the line you see at the bottom there, or second to the bottom, patronage refunds received. Those are patronage lines from their regional partners. So just like when members do business with a cooperative, in some cases there's patronage distributed back to them. Just in that same way, when local cooperatives do business with their regional partners, and I named them off, CoBank, Land O'Lakes, AGP, CHS, there are others, they also have patronage that can be redeemed back to them. And so that the sum of those two, local savings plus the patronage refunds received, are where we get the cooperative's net savings or loss. And these are before any depreciation, so before DPAD, these are before bonus depreciation, these are before taxes. And what they do with this, and this is where the allocation decision comes in, the board and the general manager will make decisions along with their auditors, of course, annually of what we're going to do with these net savings. We're either going to invest in new assets that requires they stay as equity for that investment. We're going to allocate or redeem member equity. We'll talk about what that means, and or we can pay debts. And so those are the kind of three things that co-ops are doing with their profitability. And for today's talk, more interested in the equity redemption part is what we're going to focus on. So terminology in terms of uses of profits, we have the profit terminology of local savings and net savings. This is what they do with the profits in terms of distribution. And I'm going to try and be very clear on these, distinguishing between two things, patronage and dividends. And unfortunately, the term that's often used is called a patronage dividend, all one thing. And from my perspective, they're very different. If you look at the Iowa Code, Chapter 499, when it's talking about the allocation of a co-op's profits to its members, it uses the term, the code uses the term patronage dividends, and I think that's unfortunate. From my perspective, a patronage is a payment for use of the co-op. So this is an allocation of the cooperative savings before taxes, before depreciation, to members proportional to how much business they did. A dividend, on the other hand, is the return for how much equity they have in the co-op. Now, these are confounded because patronage allocations lead to equity, but from my perspective, a dividend is a payment for how much ownership you have in the company. It's for investments, and patronage is a payment for use. And I'm going to try and keep those terms very separate. I think it helps in understanding how all this works. Importantly, if we're talking about patronage, as long as it's a qualified allocation, we'll talk what that means. A minimum of 20% of that has to be paid in cash to the members. It can be more, so there's going to be, as patronage is allocated, there's going to be some portion of the allocation as cash, some portion of that as retained equity in the members' names at the co-op level. Again, this is conditional on being a qualified allocation. I'll talk about what that means. Also, just as I said, co-ops can receive patronage from their partners. That patronage can be allocated as patronage to the co-op members as well, and so I'll show how that can happen. But two terms there, patronage and dividends, and I prefer to keep those separate. I think it helps with member education as well. Also, in terms of the uses of profits, when we talk about the patronage line, we're going to distinguish in the allocation of profits, we're going to distinguish between allocated equity and retained savings. Allocated equity, it's also called member equity or member stock or allocated membership stock. There's a million different names for this, but if it has the word allocated in there and equity, essentially what that means is it's equity in the member's name at the co-op in the equity section on the co-op's balance sheet. This can either be qualified or non-qualified, and the distinction here is this is equity in the member's names with the expectation that it will eventually be redeemed to the member. Again, we'll talk more about, I'll get into what that eventually means and how that happens and how that redemption strategy works. But this is the allocated portion of equity in members' names. The retained earnings part, they're also called unallocated reserves or retained savings. There's several names for this as well. This is the portion of the profit stream that's not specifically allocated to the membership. Now, I want to be clear, it is still members' equity. So all of the equity in the co-op belongs to the members, and the way that they get that, if they want to get at all of it, is to liquidate it. And I'm not advocating for that, but it truly is members' equity. It's just there's a portion that has not been allocated to the membership specifically. It's kept in retained earnings, and some of that is strategic, and some of that falls directly out of the tax implications of the choices that co-ops are making, their boards, general managers, and auditors are making. One of the differences is in every case with retained earnings, these are taxable. Comes from taxable income. Now, maybe they didn't pay tax on it because there was a deduction to take, but these retained earnings are taxed at the co-op level. Typically, allocated equity is eventually taxed at the member level, and I know I'm giving you quite a few qualifiers here on sometimes this happens and sometimes that. I'll explain more about that as we get into this. And if there's any questions, feel free to, if they pop up, I'll try and answer them as we go. So the equity section, this is just the right-hand side of a balance sheet. The equity section looks a little bit different if you're looking at a co-op's equity section. You're going to see something on there that you don't see on most firms' balance sheets, and that is that deferred patronage refunds. That's the allocated members' equity or retained member equity piece. You can see the common stock, that's the very first line there, and this is just an example balance sheet that's of no consequence really. That common stock typically is, those are the membership certificates. So if it costs $25 to become a member or $500 to become a member, sometimes that's broken out as common stock. These are non-marketable securities, in most cases not tradable, and in a lot of cases there's no dividends being paid on those. The deferred patronage refunds is the member equity piece. Those accumulate over time, and this accumulates as a result of board decisions. And also those are eventually redeemed to the membership, and the board decides that redemption schedule or how quickly that's redeemed. The final part are the retained earnings, and those, if you recall from the last slide, retained earnings are result from profitability that's not allocated specifically to membership. Going back to deferred patronage refunds, keep in mind that allocation to membership from profitability happens based on members' use of the co-op. So their relative share, their proportional share of business done with the co-op in that year when it was profitable. The patronage allocation decisions I have down there, and I'll say this a couple times throughout the presentation, this allocation of patronage or allocation to deferred patronage refunds impacts the size of members' equity relative to retained earnings, and that becomes an important piece in understanding how management and how boards are choosing to manage equity and some of the implications from that. So some final terminology, you've heard me say this a couple times, and this gets into some, when I talk about the toolbox that co-ops are able to use to impact equity and impact tax liabilities, whether they be at the co-op level or the member level, the producer level. There's a different, we distinguish between allocations, patronage allocations that are qualified and non-qualified. And if you were watching me, when you hear me say the word qualified, you'd see me doing air quotes. Qualified means that they essentially qualify in the way that the IRS needs them to for pass-through taxation in the current year, pass-through from the co-op to the board, or excuse me, the co-op member. So if it's a qualified allocation, the member is going to pay the income tax on the allocation. I'll go through an example later, but importantly, they pay the tax on the cash portion they receive, as well as any portion that's retained as member equity at the co-op level. Again, if it's a qualified allocation, I said this before, at least 20% must be paid in cash. Most cooperatives these days are paying significantly more than that, recognizing that members can often be in 30% marginal tax brackets, and they want to pay enough cash to at least cover the tax liability on the entire portion. When this is redeemed, so when this new allocated equity that goes into member equity at the co-op level is eventually paid out to the member, because the member paid tax on it in the year it was allocated, there's no additional tax liability generated when that equity is finally redeemed out. And again, I'll go through an example of that. One of the common complaints that we hear on qualified allocations that have very long-lived redemption schedules is, one of the members' complaints is, well, look, I paid the taxes on that money. I would like to have it redeemed to me sooner than later, and that's a valid complaint, which leads to the next way, the other way to allocate patronage, which is in a non-qualified way. And the big difference here, there are two. One, when you issue a non-qualified allocation, you're not required to issue 20% as cash. And then in this case, in a non-qualified case, in other words, it doesn't qualify for pass-through taxation in the current year, the co-op is going to pay the tax on that when it's declared. So if, I'll use an example of Farmers Cooperative, and I'm using that generically, not FC, former, the former component of Landis. When this Farmers Cooperative issues a non-qualified allocation in the current year, let's say that's year 2016, the co-op will pay the tax on that allocated patronage, that allocated equity in this year. When that's finally redeemed out, that tax then becomes a tax credit to the cooperative and then becomes a tax liability to the member when it's finally redeemed out. We see an increasing use of this in Iowa. It's a way that gives boards more flexibility, and it's a little bit more tax neutral. So like on the previous slide, I said that one of the member complaints about a qualified distribution, one of a member complaints about qualified distribution is that they're paying a tax on it. In this case, in a non-qualified distribution, the member doesn't pay the tax until they actually get the cash to cover that. Finally, one last thing to talk about that has to do with terminology and tax status, we'll get to this, is domestic production activities deduction, DPAD, or Section 199. There are several acronyms associated with this law, and I will say again, I'm not a tax expert, so I've picked up a little bit, and I can talk about the impacts of DPAD on co-op equity, but there's some rules in here that I don't necessarily understand. I don't have all of them, but I've put in what I think are the most important things to keep in mind. So domestic production activities deduction, I think originally came about, not recently, it's as of 2005, I think this has been on the books, 2005 or 2006, originally came about as a jobs creation intent or a jobs creation bill. And the idea was to give manufacturers, this is primarily who uses this, manufacturers a tax credit to stimulate job growth, and it's related to the amount of domestic production, as is noted in the title. Well, auditors and cooperatives working with auditors figured out that agricultural cooperatives could qualify for this domestic production and have been able to use it for the last 10 years or so or more. The deduction is available to the co-op based on its taxable income, but taxable income with adjustments, and by adjustments I mean additions. They can add in the grain. This applies to only the grain side of their production. They can add in grain sold on behalf of their members, the PERPIMs, the per unit retains paid in money. That's what PERPIMs is, and patronage. And that PERPIMs show up on the patronage, the Form 1099 PATR that members get from the cooperative. This deduction is huge. It's limited to the lesser of 9% of total qualified production. There's a calculation there, or 50% of the co-op's qualified W-2 wages. I believe domestic production activities deduction is also available at the producer level. I'm not sure. I heard that. But what I'm talking about is DPAD that's available at the co-op level that can be passed through in cases where the co-op can't use it all or doesn't want to use it all. They can pass that through their membership just like they can pass through patronage on the basis of use, so proportional to the members' use on the grain. And this applies to grain only. This is a grain marketing tax deduction. So we've got the terminology out of the way, and this looks like a complicated decision tree, and I've actually made it more simple. Many of you may have seen this. This is kind of my go-to figure in trying to describe how profits are distributed and how equity is distributed. This is credit to Dr. David Barton at K-State, or formerly at K-State. Technically, this is called the Cooperative Income Distribution Management Model. That's a bit of a mouthful, so I just put Barton's Saving Distribution Tree. And what you see here is this is how co-ops are going to make decisions about their savings. And that first gray bar there should not say patronage. I apologize for that. That should say net savings before taxes. So what we're doing is we're talking about what are the cooperative's net savings and how are they going to distribute this in that gray box there. And I would remind you, this is before domestic production activities deduction. This is before DPAD, any bonus depreciation, before taxes. What net savings does the co-op have to allocate, and how is it going to make those decisions? In the green boxes show the source of the funds, whether they're from patronage or non-patronage. Another way to think about this is member versus non-member. Orange indicates whether or not it's going to be allocated, so allocated versus unallocated. The tax implications, so you'll see in the red boxes either qualified or non-qualified, and you'll also see not qualified, and that means it never will qualify for taxation passed through to the members. That's the difference between non-qualified and not qualified. And then finally, distribution options, and I don't have them all listed here, but distribution options we're going to talk about are cash patronage refund or allocated member equity. What's missing out of here is the ability to pay dividends, and again, dividends are payment for equity share, not for payment and use, and the taxes. So for example, you see net retained earnings, those would be retained earnings at the co-op level net of taxes. So I just want to walk through this using an example, and I hope this example doesn't muddy the water at all. This would be a common example or a typical example of how these monies come about and how a co-op might make an allocation decision. So here's an example. Farmers Cooperative has local savings of $3 million in 2016, and they know that 75% of that is from member business, the rest from non-member business. Cooperatives are keeping track of this, and remember from one of the very first slides I said it matters where that local savings comes from, whether it's member business or non-member business, because this impacts whether or not it can be allocated to the membership. So they've got that $3 million in local savings. It was a good year, 75% from member business. And then they have an additional $1 million of patronage. They're going to count this as income. Patronage coming back from CoBank, Land O'Lakes, CHS, AGP. They're regional partners, of which 80% is eligible for allocation to its membership. So what you have here, basically, 75% of $3 million plus 80% of $1 million, that's the $3,050,000 that Farmers Cooperative has the ability to allocate to its producer members, and those are members who have production at risk, if it chooses to allocate 100%. And I'm going to make the assumption that it does. I would also like to say just really quick, because this matters a little bit, up in that second paragraph, when I talk about the income coming from regional partners, that's also an allocation that's announced. The co-op might not get the full amount, the full $1 million. It could get, for example, 30% of that in cash and $700,000 as equity in those cooperatives in CoBank, Land O'Lakes, CHS, AGP. So that $1 million of income isn't necessarily paid out. It's $1 million that's announced, and that matters to the co-op's decisions. It complicates things a little bit. I'm going to gloss over that for now. Happy to answer questions about it though. So here's this co-op. It knows its origin of savings, and there the gray bar, the gray box is correct. These are net savings before taxes, before bonus depreciation, before those types of deductions, and it knows some of that is patronage or member-based or eligible for it, and some is not. Generally speaking, you cannot allocate non-member business as patronage to members. Now, technically, you can, and no co-op does this because it would be taxed twice. It would be taxed at the co-op level and at the member level, just like regular corporations are taxed twice in their profits. That would be the default. Co-ops get the single taxation as long as they follow certain rules. But if they're allocating non-member business to members, I believe that's a double taxation route, and no one would choose to do that. So I've eliminated that from the original tree. It existed in here. Also, they're not obligated to allocate all member-related savings. So the number on the previous slide was $3,050,000 came from member business that's eligible to be allocated. Sometimes you hear cooperatives saying we're allocating 100% of the eligible patronage. That's what they mean by that. They could choose to allocate some lesser amount, 80%, 50%, whatever they need to do based on their budgeting, based on their goals, based on asset investment strategies, etc. So if I follow this example through, there's my $4 million in net savings and $3,050,000 that came from patronage lines, and that all of a sudden sets up for me how this money is going to flow through, and then the things that are impacted on the back end. So $950,000 comes from non-patronage business. Continue with the example. Farmers Cooperatives had decided that it's going to give 100% of that member-based local savings as a qualified distribution. So the stuff that came from the monies that resulted from local profitability, they're going to distribute 100% of that, 80% essentially, back to the members. 50% is cash and 50% is retained equity. So if I am a member of this cooperative, I'm going to get a notice from this co-op saying that we are allocating some of your patronage as cash, and some of it will be retained as equity in the co-op in your name. The co-op then decides that we're going to take the regional income piece and we're going to issue it as a non-qualified distribution. Now, I'm not saying that this is what co-ops typically do. We do have some co-ops using non-qualified. I'm putting non-qualified in here as an example of a way to show how this works. And I will say that non-qualified distributions make a little bit of sense in my opinion in the case of regional income, because some of that regional income is announced. It's regional income that they have to count for tax purposes, but the local cooperative, in this case Farmers Cooperative, has no control over whether that's redeemed to them or when that's redeemed to them. So then to assign it in members' names with a guaranteed redemption schedule on there becomes a bit risky if they've not yet received it from the regional cooperative. So I'm keeping those two lines separate here. So how does this flow through then? The Farmers Cooperative has says it's going to allocate the entire $3,050,000 to its membership. So none of the patronage-based, member-based patronage is going to be unallocated. All $3,050,000 is going to flow through to the membership. And that non-patronage at the bottom, $950,000, is going to remain unallocated. What that essentially means, because this is a qualified distribution, these slides correct? Sorry about this.
Okay.
Yeah, sorry. I'm looking at a slide that looks a little bit different from what I thought it might. That's okay. This is a allocated distribution. The member is going to, well, yes, okay. Sorry about that. They are going to issue some of this as a qualified, so the part that comes from the local savings, I apologize, I lost my place there. The part that comes from the local savings, they're going to issue as qualified, and that was the roughly 74%, $2.25 million. And the income that came from the regional side, they're going to issue as a non-qualified. So that's where we have this special tax implication coming in. Again, at the bottom there, the not qualified, the co-op's going to pay the tax on. The $2.25 million, the member's going to pay the tax on, regardless of whether it comes as a cash to them as a cash patronage or whether it's allocated to them as equity that'll be redeemed later. So I'll just advance it once more and show the outcome. So that what the members are going to get in aggregate, $1.125 million is cash. They're going to have allocated equity increased by $1.125 million. And they're also, in a qualified way, they'll pay the tax on the $2.25 million. The non-qualified allocation that came from the regional stream, that $800,000, it goes as allocated equity on the co-op's balance sheet in the members' names, but they don't pay the tax on that. This is a non-qualified distribution at that point, and the co-op is going to pay the tax on that. So if I want to talk about what happens, I'll talk about what happens with the co-op's balance sheet, the tax there, and then also at the member level in steps. So at the co-op's balance sheet, there's going to be no change to common stock. We haven't affected that at all. What we have affected is that deferred patronage refunds or members' equity is going to increase by $1.925 million, and that's the $1.125 million that the members paid the tax on that's allocated to them, plus the $800,000 that was issued non-qualified way that the co-op is paying the taxes on. So what you'd see then is that deferred patronage refunds from 2016 to 2017 go up by $1.925 million, barring any other redemptions that they make. On the retained earnings side, the co-op's retained earnings increased by $950,000, and that was the non-member portion of the business that was done, the savings that were done. So you'd see in 2017 retained earnings increase, all else equal. That would be the result of this allocation decision. So what does the member need to know about this? This patronage announcement will also be followed up with specifics on how they are making this proportional. So I said that patronage is issued to members proportional to their use of the cooperative. So the member is going to receive some sort of notice that says, well, this $3,050,000 allocation equates to 2 cents a bushel on grain and 2.5% on agronomy purchases. And they could also be a proportion of if the co-op has lumber, a lumber yard, if they have fuel services, any other services that they provide, they can have different patronage pools and allocate based on that. But this is what a member might see. And so if I have these fictional members, Sarah and Steve, they hold a single membership, they're producers, and in their case they sold 110,000 bushels through the cooperative and bought inputs totaling 180,000 from it. That gives them an idea of what their allocation is in this year. So their allocation is going to be 2 cents a bushel times 110,000 bushels plus 2.5% of their $180,000 purchase of inputs from the co-op. So their share this year of the profits is $6,700, and the co-op would repeat this, every member this repeats for, to figure out what share each member has of the profitability. So how does this break down? We can walk through this. The qualified portion, because there's a qualified portion which has implications for taxes and a non-qualified portion, we keep these separate. The qualified portion, which is approximately 74%, is $4,958. 50% of that came as cash. The member is going to receive a check or cash allocation for $2,479. And they're going to receive notice that equity has been allocated in their name at the co-op of the same amount, $2,479. 50-50 split on the cash and allocated equity. Co-ops sometimes choose 60-40, they can choose 70-30, 50-50, I just picked a mid-range here. They can also choose 100% cash allocation with no allocated equity on a qualified way. The non-qualified portion turns out to be about $1,700 of this, and that all goes into allocated equity. Well, so what's the tax on this? If I assume these members are in a 30% marginal tax bracket, they're going to pay 30% of the entire qualified amount, which amounts to about $1,487, and their net cash. So they will receive a check for $2,479 is their check, and out of that check, they have to pay the liability generated from that is $1,487, and that's why you see there I have that net cash of $992. That's their net cash after the tax liability. Now, if there are again, I'm not a tax professional, so to the extent that their marginal tax rate is lower than that, or things that are done with taxes, obviously their net cash would be different than that. This is just as an example. Their allocated equity in the cooperative increases by the sum of these two, $2,479 and $1,742. So Sarah and Steve, these members, now have additional equity in the cooperative in that amount. What happens at the co-op level? Well, the co-op's going to pay taxes on that $950,000 that came from non-member business that went into retained savings. They're going to pay the taxes on that. They could alternatively choose to pay dividends out of that as well on preferred stock or other stock. And they are going to, it's the $1,742 for the non-qualified allocated equity is also a tax liability for them in this year. So even though that's equity in Sarah and Steve's name, the co-op is going to pay taxes on it for now because it was issued in a non-qualified way. When the equity that Sarah and Steve is redeemed, we have another potential for a tax liability. So if the allocation was qualified, remember Sarah and Steve pay the tax on it in this year. If it was issued or announced in 2016, it would count towards their 2016 taxes. When it's redeemed to them, however long later that is, 10 years, 12 years, whatever that might be, there's no new tax liability generated as a result of that. However, the non-qualified part, if I go back $1,742, that non-qualified equity in Sarah and Steve's name is the tax liability occurs at the co-op level in the current year in 2016, and when they redeem that out to Sarah and Steve, let's say it's 10 years later, all of a sudden the co-op is able to take a tax credit at that point, and Sarah and Steve bear the tax burden in the year in which they receive the cash. So it's a bit of a tax transfer in that sense. Equity redemption happens in a couple different ways in co-ops in Iowa. I'm going to talk about two common ways. There are other ways to do this. Typically co-op, and it's a choice. Typically co-ops will be on an age of patron program, or they'll be on an age of equity or revolving program. And so the age of patron is probably a more common one, although co-ops are starting to switch away from this. The age of patron program says that the co-op will choose to start paying out that redeemed equity that's been built up over a number of years when the member reaches a defined age, whether it be 65, 70, or 75. And this is where that adage you hear that members say I have to die to get my money out of the co-op, this is where that's coming from, is these age of patron programs that have these equity redemptions that rely on the member reaching a certain age and then a rather accelerated redemption schedule at that point. The co-op will begin to pay out the equity that's accumulated over 35 or 40 years. The other way to do it is an age of equity or revolving equity program, and here the co-op is going to take this stance of we're going to redeem the oldest equity first. It's like a first in, first out system. So we've got equity in members' names sitting in our books from 20 years ago. As we have profitability and as we have the ability to redeem that equity out to the membership, we're going to pay off the oldest stuff first. So if I'm going back to my example, Farmers Cooperative, if I assume that they're 12 years back, I'm redeeming equity, and that's about average here in Iowa. We have some co-ops that are lower than that and some that are higher than that on an age of equity program. If they're back currently 12 years, that $4,221 in equity that Sarah and Steve built up this year will be redeemed to them in the year 2028, so 12 years later. Now remember, some of that was qualified, so some of that they won't pay taxes on in 2028, and some of it they will. The $1,742 they will back then, or they will then in 2028. So the next topic and kind of the final topic to wrap this up is DPAD and how this affects everything. And I have glossed over this, but if I introduce this little wrinkle called DPAD that exists at the co-op level, I'm going to go back and say, okay, Farmers Cooperative had $4 million in net savings before taxes. They plan to allocate $3,050,000. But because of this DPAD allowance, because they have the ability to deduct up to, for example, 50% of their W-2 wages, they're going to take an allowance of $2.3 million, which means they're going to reduce their taxable income. So a reduction of the taxable income by the amount of this domestic production activities deduction, or Section 189, effectively reduces the amount that can be allocated to membership. So if we go back to this Barton savings distribution tree, and I preserve all the other proportions that were set up initially with 50% cash, 50% allocated equity, keeping the same proportions of the local savings generated versus regional, you can see the impact this has. Taking the DPAD deduction at the co-op level reduces the amount that qualifies for pass-through to the members. If the co-op's not paying tax on it, if they're taking it as a deduction, it's no longer income that can be passed through. So that reduces the total amount that will be allocated to membership through the patronage route. It drops from $3 million to $1.7 million. It reduces the amount all the way down of the cash patronage refund. It reduces the non-qualified on the tax transfers and increases in a significant way the non-patronage equity, and that's the equity that goes in retained earnings. And remember, retained earnings, these are the earnings that the co-op either is going to pay taxes on or not, but these are earnings in no one's name. These are not allocated to membership. Importantly, this is still member equity, but this DPAD deduction, this domestic production activities deduction, is an incredible tool for the cooperative to take advantage of taxes. It's without a doubt a competitive advantage, but it has the effect of reducing the amount that can be allocated to membership. And that's the point I wanted to illustrate here. I think there are pros and cons of this. The very positives of this DPAD, it reduces the total taxes paid by the system. And when I talk with auditors and they talk with their board members, farmers don't like to pay taxes and co-ops don't like to pay taxes. It's no different. It allows co-ops to quickly grow their equity. So this has been in the last 10 years, have allowed co-ops to really bolster up their equity. In the past, it's been difficult for co-ops to gain access to capital because it required profitability to go into equity, and that was a slow acquisition. They can't go out and raise investor capital or risk capital the same way non-cooperative corporations can. So this has allowed them to add quite a bit of equity to their balance sheet in a fairly short period of time. Another benefit is they can allocate DPAD to its members as a deduction to take. That's one line that I didn't show. But if the co-op couldn't use all of that domestic production activities deduction in the year, or if they chose not to, that can be allocated through to the membership. So the membership can take that as a deduction on their taxes. Finally, another benefit of this, and there may be more, it improves the co-op's competitiveness in the local area. I think I've said that, but this is definitely a leg up that cooperative firms have that non-cooperatives wouldn't have access to necessarily. The drawbacks of this is, and this is, I think, some things we hear members talking about, to the extent that DPAD is not allocated to the membership, it does reduce the patronage co-ops can allocate to them. So what you get in the second bullet, it can quickly result in this unallocated section of the balance sheet, the retained earnings, growing relative to the allocated equity in members' names. And what we've seen over the last 10 years is a significant shift in the proportion of members' allocated equity to retained earnings. And retained earnings has grown much faster than members' allocated equity has. And so we see a mix of where we used to see, for example, maybe 60 or 70% member equity to retained earnings at 30 or 40%. Now it's kind of flipped. In some cases it's 70 or 80% retained equity and unallocated equity, retained unallocated reserves to maybe 30 or 40% member equity. The other challenging thing about DPAD is it can be difficult to explain to members. It's not an easy concept to explain and wrap your head around, and members also don't understand it. So when they see the cooperative not allocating patronage and retained earnings going up really quickly, that's puzzling to them. They don't understand the mechanism by which that happens and the need for that. If they're going to take advantage of DPAD, this is really the only way to do it. Where do these show up? So I think a lot of you probably are familiar with this form in a 1099 patronage form. What we've talked about today has implications for box 1, which are the qualified allocations, these patronage dividends. Box 3 are these PERPMs. That is what allows the co-op to adjust their local income, adjust their net savings to be able to take advantage of the DPAD. Box 6, these are the DPAD allocations, if any, to the membership. So if instead the co-op had decided of taking the $2 million sum domestic production activities deduction, had allocated that to the membership, Sarah and Steve would see something in their box 6, which is domestic production activities deduction, that was their allocation of that they could use as a tax deduction from their income taxes. Finally, box 5 will be the non-qualified allocations. So those are notices, those are redemptions in non-qualified at the point not at which they're allocated, but the point at which they're redeemed. So if there's any redemptions in non-qualified, those would show up there. So common questions that I get, that I'm trying to anticipate questions you all may have: why would a co-op use a non-qualified allocation? It seems more complicated, and that can be the case. Non-qualified is a mechanism that really gives the co-op some flexibility, the ability to allocate equity to members while also not imposing a tax liability on them before they get the cash. So before liability there, I should have had the word tax. So non-qualified is becoming more popular because it separates the allocation from the tax liability until the member receives the cash, and that is appealing to membership. Non-qualifieds also give co-ops a little bit more flexibility.
Keri, can we go back to the form real quick?
Yes.
We have a question.
Mm-hmm.
Could you explain box 3 a bit more? Does it have anything to do with the sales the farmer made to the co-op?
Yes, so per unit, PERPMs, per unit retains paid in monies are when grain, and this is to grain only, when members sell grain through the cooperative, if it's issued as a PERPM, and they have, I believe the co-op, this is where we're getting into an area where I may not have all the facts straight. If the co-op issues this as a sale on behalf of the member, and not just the member sold grain to the co-op, but the co-op sold it on behalf of the member, I think is the distinction, that counts as that PERPM, and that's what would show up then in that box 3. That should be the farmer's what they have, the farmer's sale through the cooperative,
yes,
that the cooperative was marketing on their behalf.
That I would agree with that.
And that's an important distinction.
Yeah. Mm-hmm. Good question, Teresa. Okay.
Are there other questions on this form?
It'll take a while to input it. Therefore, is box 5 not taxable?
So I think I misspoke. So box 5 are the non-qualified redemptions. I believe, and someone should check me on this, these are not the notices of the non-qualified, these are the non-qualified redemptions. So let's say in my example, Farmers Cooperative issued to Sarah and Steve some non-qualified equity. Let's say we're near 2028 and they're paying that out. That non-qualified part would show up on their taxable distributions as a redemption of that non-qualified, I believe.
Okay, this is beyond my level here. We are going to run a DPAD seminar this summer. Al, if you want to send that question to my email or Keri's at the end, we'll see what we can do between the two of us to get that question addressed, okay?
I hope I haven't misled anyone.
It wouldn't be the first time that I said something wrong either, Keri, so don't worry about that. Okay, any other questions on the form? Okay, so the box 3 amounts are reported as a sale by the member, as if they had sold the grain, etc., directly themselves, wanting to know how to handle box 3 on the tax return. Well, box 3 on the tax return is the sale of grain. Remember, they didn't have this on the form 1099 PATR. I'm sorry, I think I know the answer to this one, Keri.
Please do.
Okay.
Yeah, please do.
We didn't have that for quite some time, and you always used to, on the Schedule F, and I'll just refer to Schedule F, put the sale of the grain up in line 1 or line 2. Okay. Well, when we come to these per unit retained allocations, that's what is on the PATR, and that's what goes on the line that's for PATR, and that's the sales that were made directly from to the co-op, or what the co-op sold. There's other sales that you would include elsewhere, but you want your 1099 PATR for that specific line on the Schedule F to match what is on the tax return. And I think that's the best way. I don't quite have the line numbers lined up, but about 5, 6, maybe a little longer, many years ago, we had a systemic where people didn't understand what per unit retained allocations were, and they put everything up in the above line, and none of the PATRs matched, and IRS sent out a bunch of CP 2000 notices. The income was on the Schedule F, but it wasn't where the computer was looking for it to match on the 1099 PATR line on the Schedule F, okay? I think that answers that. Now, slide 9. We can go back to slide 9 here. Hold a second, and let me go back to slide 9. And we were on 27. Okay. So let's go back to slide 9 real quick.
I think Gail is trying to offer an explanation for the question above.
Okay, says that slide 9 says that the redemption, the member pays income tax and co-ops receives a taxable deduction or a credit on the non-qualified.
Yeah, I think the question was, referring to box 5, the question was, is that where the co-op is reporting this year's announcement of non-qualified allocations, or is that where the co-op is reporting this year's redemption of non-qualified applications? If it's an announcement of a non-qualified, allocation, the member won't pay the tax on it this year. If it's a redemption of a non-qualified allocation that goes in box 5, then the member is required to pay the tax on it. So that's what we need clarification on, is box 5 a notice of allocation of non-qualified or a notice of redemption of non-qualified? It says redemption in there.
Okay, and so let's look at our 1099 here. Hold on a second. I got to exit out of this. And let's go back to our 1099 because the wording could be important here.
It says redemption of non-qualified. So I think that's the amount that's being redeemed.
Okay.
If it is the amount that's being redeemed, the non-qualified that was prior notice was given and now it is being redeemed, the member pays the tax on it this year.
Okay. What about box 2? That is that non-patronage, non-taxable distribution?
Non-patronage refers to something that doesn't result from from member business, patronage business. That could be something like
Was that on your
dividends on
chart?
equity.
Okay.
No,
Okay.
we didn't talk about that today.
Okay. Will deferred payments be included in the year of sale, not the year of payment? I guess we need to define what you mean by deferred payments. From the co-op, you mean the co-op's deferred payment? Clarify that for us. So both box 1, PATR dividends, and box 3, per unit retained, are entered on the co-op patronage dividends on F. Okay. So your dividends are one thing and your per unit retained is another thing. Okay, those are two separate things. One, are those really dividends?
Patronage?
Yes.
So no, it's patronage. It's not dividends.
It's really patronage.
It's patronage.
Yes. So this is really not the dividend as we think of dividends.
No.
Okay, I would have to look at the instructions on that one. I probably should have printed those off, but we were running a little behind this morning, so I don't believe I can address your question directly on there. There may be somebody here on the session that may be able to help us out.
And I would say box 3, that's not related to patronage. Box 3 are grain sales. Yeah, yes. Grain sales, which are different than patronage.
Right. Okay. So you are going to have your 3 would be your box 3 will be your grain sales, and that's been moved down to where it was line 2, I believe, or line 1, and now it's in the PATR area. Okay. Now going back, will deferred payments be included in the year of sale, not the year of payment? And you're referring to the co-op deferred the payment. Those would be included in the year of sale, or are they in the year of payment?
You mean for purposes of the members' taxes, the producers' taxes?
Yes, I would think that's where she's coming from.
I think it matters. So the co-op is going to, I believe, this is what I think happens. The co-op is going to claim them in the year of sale, not payment, because they do accounting on an accrual basis. All of their records are accrual. Now, if the member has chosen a cash accounting
Most
system,
of them are, yes.
Then they would report it based on when they received the cash.
Payment, right.
Yeah, the payment for it. So I think there's potentially a mismatch there.
Unless there are a few farmers out there who are on the accrual basis.
Yes.
Very few.
Mm-hmm.
Okay. But there are a few out there. Okay, let's go to, we did this one, right? So this will be our next common question. Okay.
And thanks for those questions. I'm going to stray a little bit and just, like I said, answer some questions or try and anticipate some that I've received in the past. If I leave the co-op, does the board have to pay out my equity? So this is stemming from just generally speaking, members don't have control over when the equity they have in the cooperative is redeemed. That's a board decision. The board makes that in conjunction with the management and the auditor. And they do this with an understanding of how much equity is needed to support the business's activities and all these other reasons. If you leave the co-op, the answer to that is no, the board does not have to pay out your equity immediately. In most cases, that equity, your equity that's built up over time, is going to be redeemed on the same schedule as other equity. So if they've chosen a first in, first out, or a revolving age of equity redemption strategy, it'll be paid out in line with that. So maybe 12 years later or 15 years later, whatever schedule they're on. If they've chosen age of patron, that's how it'll be paid out. Now, that's not to say the co-op board does have discretion, and they can choose to prioritize it. They can choose to pay it out sooner, but it's not callable by the membership. The member can't ask for it back. What they can ask for back and what is redeemable immediately is their membership share. So if it cost them $500 to join the co-op and that's their membership certificate or their membership share, that's payable, I believe, within 2 years. Looks like we have some other questions.
Okay, I'm looking at, let's go back to the 1099 miscellaneous. On box 3, to try to address one of the questions here, the instructions basically say enter the total per retained allocations paid in cash, qualified per unit retained certificates, the face amount of those, and other property. So that's what goes on line 3. So these are the allocations paid out in cash. Now, if we go to box 1, you enter the total patronage dividends. Those are dividends, like you said. They're not really called patronage dividends. They're dividends, right?
They're talking about patronage.
Patronage dividends, yes. Okay, that are paid in cash, qualified written notices of allocation and other property except non-qualified written notices of allocation.
So if we go to the example of Steve and Sarah, it would be the total of the cash they received plus the qualified allocation, which turned out to be, in all members, if we go back, the $2.25 million in aggregate. Sarah and Steve, I think, were $4,721, something like that, right?
Yes.
It would be the cash plus the allocated equity is what is in that box 1.
Okay, I'm bringing up the Schedule F right now. So the question is, Schedule F, line 3A instructions, if you receive distributions from a cooperative, you should receive a Form 1099 PATR. On line 3A, show your total distributions from the cooperative. This includes patronage dividends, non-patronage distributions, per retained allocations and redemptions of non-qualified written notices of allocation and per retained. So let's go back to our form and let's look at that real quick. So it's saying that you should include boxes 1, box 2, box 3, and box, let me see, the redemptions of non-qualified. Box 5 should be included on line, and thank you, Sam, on line 3A. I was just bringing those instructions up. Okay, now someone has made another comment. LaCert has an entry line for total cooperative distributions and the line for taxable distributions. So we would have to combine some figures, and it seems to me, based on the instructions, and again, thank you, Sam, that we would include everything in these boxes as the instructions say. And, you know, this used to be much different a few years back, so it's always good to check on your form, your Schedule F, anything new, because this was new a few years back, and a lot of people did miss that. Okay, so let's get back to our other questions that Keri's tried to anticipate. It's okay. Here is this. Did we do this one?
We did.
Okay, and this one?
We did. Yeah.
Okay, so we're here, there. Okay, let's get to this question and see. Okay.
So another question that commonly comes up from member producers: why is my co-op putting so much in retained savings? Is that illegal? The answer to that is no, that's not illegal. I think some think that co-ops are not for profit and therefore shouldn't be holding back profit, but that's not true. Retained savings, or these unallocated reserves, are actually serve as a pretty important and useful tool as a cushion against losses. And so that in the years in which losses do occur, and they do, it allows them not to have to reduce the member equity, the equity allocated to membership, but they can reduce that. They can put it against that retained savings. So retained savings also, and this is probably more important, serve as permanent equity. This is equity that is not going to be redeemed out, and that matters a lot when it comes to leverage for purchasing assets and their ability to grow the cooperative. So if you can imagine that you had equity in your own farm operations, if you've got a farm operations, or your clients, if they had equity that had to be kind of redeemed out on this somewhat consistent schedule, it would be very difficult to grow equity. Well, this retained savings serves as permanent equity, and the ability to leverage and borrow against that is pretty important. And no, it's not illegal. How does retained savings grow really quickly? Well, DPAD has resulted in that. And there's really not a choice here, as I understand it. Domestic production activities deduction, if it's taken at the co-op level, that amount by which their income was reduced is added to their retained earnings, because technically the taxes are paid and it's a zero tax rate at the co-op level, so it wouldn't be passed through to the membership. But no, it's some of that is coming through by choice, putting some into retained savings, and some is coming through because they're utilizing this really incredible tax advantage that came along.
Okay, let's see. Another question. A retired farmer receives a 1099 PATR, likely for fuel purchases. He doesn't file a Schedule F anymore because of retirement is the amount because of retirement. Is the amount on the 1099 PATR to be reported on line 3A of the Schedule F with no other entries, or is it to be reported on line 21, other income on the tax return? I've seen it both ways. Okay, we're getting into tax issues here, and I didn't anticipate that because I'm going to be running a class this summer. Brooke, send me that question. We'll see what we can do here. Just because he's a retired farmer doesn't mean he doesn't have income subject to self-employment tax. So we're going to have to look at this to see how this will impact the tax return. We just wanted to do today to give somewhat of an overview of how co-ops work, so we could kind of set the stage of getting into more of the tax issues where we could offer some CPE credits. So I didn't really carry it that far, and I apologize if you expected an answer today. So we will enter into that more this summer when we begin our webinars. Okay, so we'll have to look at it. Someone said if he isn't farming, they think it's a front page line 21, but we also know that 21 is often questioned by IRS, so we want to make sure we put it in the right place, and if it's on line 21, we have to have a proper description to avoid that inquiry. So I will save all these questions and everything, and as we go back through them, it will help us prepare for maybe some other co-op classes this year, okay, as well as some more questions on the DPAD and how this will appear on the tax return. Some people say I have reported it on the Schedule F and have no questions answered, no questions from IRS. Now, another question. If patronage is earned on something other than in the course of a business, is it not taxable? That's another tax question we're not going to be able to address today. We did not intend to get into the tax issues. Our mission today was to provide a little bit more background. Okay, would a co-op ever get to a point where they didn't need to increase their retained earnings so much as they allocate more to members?
I would say the answer to that is yes. So co-ops are constantly trying to manage this equity section, and it happened before I came on the scene, and this happened before me, and I'm catching up and learning the history here. What I understand, the use of DPAD came along, and it had these unintended, in some cases, these unintended consequences on the balance sheet. They never knew the retained savings could grow so quickly, and it has been a useful tool. Co-op board members are now, and the management are starting to realize that, hey, it didn't get out of control, but it got to a point that they didn't intend it to get. And I think most cooperative boards, along with their managers and auditors, have something in mind in terms of what they want their mix of equity to member equity to retained savings to be. And so they use these tools to try and manage that. Some co-ops have a target of 60-40, some 70-30. It really depends on the cooperative culture. It depends on their strategy going forward, the asset investments they may need to make. It's different every co-op, but yes, co-ops do make that decision, recognizing that there's value in having members' name on equity. Members value that. At the same time, trying to balance that need for retained savings. So it's a constant balancing act. And this tax issue, although it's a nice problem to have, the DPAD. It is something that they have to manage very carefully.
Okay, Sherry, yours is a tax question. I'm going to defer that for later on. You're welcome to email that to me, and I will do my best to address it. We do have another question for Keri, though. Is that percentage of allocation change from year to year, or is that a set amount?
From what I understand, the co-ops have the ability to change that allocation from year to year. Every year it could be different. That's part of their toolbox. Now, because that's difficult to explain to the membership, many cooperatives will take the stance that they're going to try and be consistent with their allocation. So you would see them consistently doing 40% cash, 60% retained earnings, or 50%, 50%. And they do that because they feel it's easier to explain to the membership. I think it's more optimal that they have a target for what their equity mix is and adjust their ratios, adjust their percentages of allocations to meet those targets. But yeah, those targets can change from year to year. They're not locked into anything.
Okay.
Thanks for that question.
Let's go on to this one.
So really last slide, like what to watch for in 2017. Obviously you guys know tighter margins in ag, likely lower local savings, trying to say that's 5 times fast, local savings at the co-op level, and potentially lower regional income. What should we expect to go on with these allocations and equity and patronage? I think potentially we're going to see some slowed equity redemptions. So if a co-op is on a revolving equity program, they may not be able to, for example, redeem an entire year of equity at once, especially if they get into, with our baby boomers retiring. We have some individuals who hold large, significant portions of allocated equity in the cooperative, and as they begin to retire, I think that's going to have a bit of a drag on that equity redemption schedule on a yearly basis. Also, potentially, members should expect, and co-ops are having decisions about how you allocate losses. So co-ops have the ability to allocate losses to their membership instead of writing it against membership equity, or in addition to, you can reduce member equity and then you send that as a loss to your members as a write-off against their income in that year. That could be really valuable to members too.
On that question, the allocation of losses, that is one of the questions in the queue as to how does that show up on the tax return, and I will have to research that. Apologize, but that we weren't really getting into the tax return today. We were just trying to give some basic information. Another question, do you see co-ops issuing common stock dividends in an effort to reduce retained earnings?
So some co-ops do, maybe I'm not understanding the question. Some co-ops do issue dividends, and I'm differentiating between dividends and patronage. They issue dividends on preferred stocks. These are dividends as payments on equity. As a way to reduce retained earnings, I don't believe so. I mean, that doesn't strike me as a useful way. It would be challenging to have a significant enough impact on retained earnings to issue that amount of dividends. And the other thing is with cooperatives, there's a requirement that dividends be subordinate to patronage. So the co-op shouldn't be paying dividends before it's allocating patronage and redeeming equity. So boy, that stumps me a little bit. I don't think that they're doing that, but they may be.
We have another tax question. I'll just defer, and we are saving these questions to cover at a later time. You're also welcome to send me an email, Lynn. Okay, so let me get you back to where you are here.
Right here. So the very last point I had is also what some things to be watching for, and this is going to generate more tax questions, is the DPAD allocations to members. So in the event that co-op's income is dropping and they can't use all of their allocations, those are eligible then to be, they can't use, all of the domestic production activities deduction. That's eligible to be passed on to the membership. So I think if you're a tax professional, looks like we have some on the line here, several on the line, looking for those DPAD allocations and having a conversation with your clients about what those are. And co-ops are having those discussions as well in their newsletters about what DPAD is and how they can be of value. They're of great value to the membership, I believe. So those are just some things to watch out for, and that was my fault for throwing up there a 1099
Oh, that's
PATR.
okay. That's okay. I figured we'd get some tax questions. We have one more. Once the co-op picks a redemption method, either the age of patron or the age of equity, do they have to stick with that choice, or can they change it on an annual basis?
They can change it, but I don't think it makes sense that they would change it on an annual basis. That'd be really challenging to do. So we've had co-ops switch from an age of patron to an age of equity, revolving equity, recognizing that they don't want to wait that long to pay out member equity. I don't think they'd go back, or they wouldn't switch back from a revolving equity to an age of patron. I don't think we hear about any cooperatives doing that. And making that selection year after year and choosing that would not work well. It wouldn't make sense. So no. Now they can change it, and the board can decide to change it, but I don't think we see them switching back and forth. That doesn't make a lot of sense to do that from them.
Okay, let me make a comment here. We did somewhat get into some tax issues, and I would like you to send those to me, because we're planning a DPAD, a 2-hour DPAD seminar this summer. So if you have additional tax issues, I welcome those to be sent so we can include them in our webinars this summer. And maybe we can also get Keri to expand on what she's taught us today into some of the other areas. There appears to be interest in how the co-ops them work, and we just really only had time to give you basic information today, right? Yep. So there's a little bit of a survey as we conclude. I have saved all the questions into my computer here, so we will try to save those, and if you send anything to me, I'll try to get you an answer. Do you have any final comments, Keri?
No, just thank you for having me. Thank you for the questions, everyone. I appreciate the interest, and that survey is my fault. I sure would appreciate you taking the time to answer those questions so I can have some feedback on whether or not this was useful and whether they'd be interested in having more information, I guess, webinars related to cooperatives.
Right, and if in more, we want to really do more, we'd have to offer them as free because we don't get into tax issues. So it would be a great thing to offer a series of free. So also, if you have additional comments, send to Keri. Her email's on on your screen right now, to kind of give her an idea of what you're looking for. There's not much room to put it in the survey, but I'm sure you'd welcome any comments.
Of course, yes, please. Okay. And happy holidays to everybody.
Yes, happy holidays, and thank you all for attending today. Sorry we're not able to get all your tax questions answered, but we will get to those as we proceed into our tax season, okay? Thank you all. Have a happy holiday and take care. Bye-bye.
Thank you.
Don't forget to do your survey.